The global financial architecture is currently witnessing a phenomenon that systemic risk analysts have long theorized but rarely observed in practice: the kinetic decoupling of physical commodity markets from their paper derivative proxies. As of the morning of January 7, 2026, the financial world has awakened to a reality where the spot price, the digital abstraction flickering on terminals in London and New York, has ceased to function as a reliable indicator of value. The market is no longer pricing an asset. It is pricing the collapse of the mechanism itself. Intelligence scans from the last 12 hours indicate a state of systemic failure across the retail bullion network. While the Western spot price oscillates violently between $72 and $80 per ounce one, the physical street price has detached completely. Reports from the ground confirm that the mania phase has arrived, characterized not by the exuberant greed of a bubble, but by the desperate panic of a bank run. Local coin shops, the canary in the coal mine for physical demand, are reporting total inventory wipeouts. The shelves are practically empty, backstock is non-existent, and dealers are selling their very last ounces, including numismatic proof coins usually reserved for collectors, at standard bullion prices. The distinction between collectible and commodity has evaporated. In a crisis, metal is metal. The panic is palpable. Customers are lining up 20 deep hours before store openings, driven by a primal fear of missing out, as mainstream media begins to cover the $80 price tag. This is not merely an investment trend, it is a liquidity event. Individuals are reportedly liquidating real estate and other hard assets to acquire any silver available, signaling a complete loss of faith in the currency. Wholesale networks have frozen, with major suppliers raising premiums over the weekend while markets were closed, a behavior indicative of a supply chain that has lost faith in its ability to replace inventory at any price. The dealer wholesale price for generic rounds has hit $89.90, even as the screen price lags at $78, creating a disconnect that renders the paper market obsolete. The Merck signal, a voice in the wilderness. Amidst this chaos, the release of the analysis featuring Axel Merk serves as the intellectual anchor for the bull case. Merk, a veteran of the currency wars, asserts the unthinkable: this isn't a bubble. While the financial media frantically frames the $80 price as speculative froth akin to the dot-com era, Merck's analysis pierces the veil of the transitory narrative. He posits that we are witnessing a fundamental repricing of hard assets against a dying dollar. With copper nearing $6 warrant dollars and silver reclaiming $80 one, the correlation is clear. This is not an asset bubble, but a currency collapse. Merck identifies a diversification driver that is fundamentally different from speculation. Investors are not chasing yield, they are fleeing currency risk. The US dollar index, DXY, has fallen by more than 8% year-to-date in 2025, eroding the purchasing power of the currency in which commodities are priced. Therefore, the rise in silver is largely a reflection of the fall in the dollar. The John A.G. analysis confirms that this is a re-rating event. When the measuring stick shrinks, the asset measured against it appears to grow. The global dashboard, red alerts. The dashboard of global risk indicators is flashing red. Gold has breached the $4,500 barrier, acting as the quiet anchor to silver's volatility. Yet, it is silver that has captured the zeitgeist. The Google Trends data for silver price has doubled the peaks of previous squeezes, signaling a mass psychological shift from investing to hoarding. This table illustrates the fracture. A functioning market cannot sustain a $50 spread between two major hubs unless the transportation mechanism has failed, or the product in one market is not the same as the product in the other. The Western price is for a paper promise. The Eastern price is for physical delivery. To understand the violence of the current move to $80, one must exorcise the ghost of the Hunt brothers. The financial media constantly invokes the Hunt brothers to dismiss the current rally, arguing that because silver hit $50 in 1980 and subsequently collapsed, $80 today is a bubble that will end in tears. This is a fatal analytical error that ignores the erosion of the currency over the last 46 years. The fallacy of nominal highs. A direct nominal comparison between 1980 and 2026 is a deception. The $50 peak of 1980, when adjusted for inflation using the government's own flawed CPI data, translates to approximately $170 in 2026 dollars. However, if one utilizes the ShadowStats alternative inflation metrics, which correct for the convenient removal of food and energy costs from the official basket, and the methodological changes of the 1990s, the 1980 peak represents a value closer to $960 per ounce. At $80, silver is not expensive, it is cheap. We are not at the top of a bubble. We are barely back to the baseline of 1980 purchasing power. The The John A.G. analysis suggests the run to 3 digits is a mathematical certainty, not a speculative hope. The market is simply catching up to 4 decades of monetary printing, the volume anomaly, the mob versus the cabal. The structural difference between the 1980 squeeze and the 2026 event is the nature of the participants. The Hunt squeeze was a concentrated attack by 3 men, Nelson Bunker, William Herbert, and Lamar Hunt, who utilized leverage to control nearly 1/3 of the world's privately held silver. Their position was fragile because it depended on the continued availability of margin credit. When the regulators changed the rules on Silver Thursday, March 27, 1980, limiting position sizes to liquidation only, the Hunts were destroyed. The 2026 squeeze is a distributed attack by millions of global actors. This includes the diffuse army of retail investors, 13 sovereign nations like China and Russia, hoarding for strategic reserves, and industrial giants who are price inelastic. You cannot margin call a solar panel manufacturer who needs silver to exist. You cannot regulate a Chinese housewife buying bracelets in Shanghai. The mob has surrounded the palace, and the regulators have run out of bullets. The crime scene of December 2025. We have already seen the 1980 playbook fail in real time. In late December 2025, the CME Group attempted to cool the market by raising margins to $25,000 per contract. Historically, such a move would flush out the speculators and crash the price. In 2026, the result was the opposite. The price dipped for 24 hours, then exploded to new highs. This reaction proves that the buyers are not leveraged speculators. They are cash buyers who view the margin hike as a sign of exchange weakness, not strength. The ghost of 1980 has returned, not to haunt the bulls, but to bury the bears. The centerpiece of our current intelligence is the detailed breakdown of the Axel Merk interview. Merck's assertion that "this isn't a bubble one" is grounded in the mechanics of currency debasement and the unique economics of the mining sector. The margin miracle, a 600% expansion. Merck identifies a specific anomaly in the mining sector that the market has largely overlooked: the greatest margin expansion in a generation. While the price of silver has tripled from its 2024 lows, the cost of mining it has not. Input costs such as energy, diesel, and labor have remained relatively stable or risen at a rate far below the metal's appreciation. Consider the arithmetic of a primary silver miner. If the all-in sustaining cost, AISC, is $20 per ounce, and silver trades at $30, the profit margin is $10. If silver rises to $80, the profit margin expands to $60. This is a 166% increase in price, resulting in a 600% increase in free cash flow. Merck notes that this operational leverage is exceptional. This explains why mining stocks typically amplify gold and silver's price movements. Yet remarkably, these stocks have not yet priced in this reality. The institutional void. Paradoxically, Merck points to the lack of institutional participation as a bullish indicator. The rally thus far has been driven by central banks and retail smart money. Large institutional asset managers, pension funds, endowments, sovereign wealth funds have been slow to pivot, remaining underweight in commodities. The market cap of the entire primary silver mining sector is smaller than a single mid-cap technology stock. When these institutions finally decide to reallocate even a fraction of a percent of their portfolios into the sector to hedge against inflation, the influx of capital will overwhelm the available equity. There are simply not enough shares to buy. The John A.G. analysis views this as the powder keg phase. When the generalist funds panic buy into the sector, the tiny door of the silver market will be ripped off its hinges. The Fed pivot and the Warsh prediction. Merck's commentary extends to the geopolitical management of this crisis. He suggests that the Federal Reserve is openly divided and identifies former Fed Governor Kevin Warsh as a potential candidate for the next Fed chair to reform the Fed in earnest. This implies a recognition within the elite that the current monetary regime is unsustainable and requires a hard reset rather than continued tinkering. The Fed is trapped. It cannot raise rates to defend the dollar without bankrupting the U.S. government, paying interest on $36 trillion in debt, and it cannot lower rates without sending inflation and silver to the moon. Here lies the smoking gun. In a functioning global market, the price of a commodity is uniform, minus transport costs. Today, we are witnessing a great disconnect. The spread between the Western paper price and the Eastern physical price has blown out to $10 to $50 per ounce. This arbitrage should not exist. It persists because the West is effectively out of silver. The Roach Motel strategy. China's export ban. On January 1, 2026, China implemented a silver export ban, disguised as a licensing regime. Only 44 entities can export silver, and the requirements are draconian: 80-ton production threshold, 30 minutors credit facilities. China, which refines 60 to 70% of the world's silver has effectively closed the exit doors. Silver checks into China, but it never leaves. This has created a bifurcated world. The Western price is a ghost price, a price for metal that you cannot have. The Eastern price is the real price, the cost to actually possess the metal. This silver curtain means that the Shanghai Gold Exchange, SGE, is draining the world of physical inventory. SGE inventories have plummeted to 715 metric tons, a decline of 86% from their peak. The physical metal is vanishing into industrial stockpiles and the vaults of the People's Bank of China, leaving the Comex with nothing but paper liabilities. The CME cooling system failure. On December 29, 2025, as silver threatened to break $86, the CME Group halted trading for over 10 hours due to a cooling system failure at their data center. The John AG desk views this explanation with extreme skepticism. Exchanges do not just turn off during record volumes unless they are protecting the house. The timing, right as silver threatened to break the commercial shorts, suggests a circuit breaker of last resort. It was a digital bank holiday, a sign that the exchange itself was on the brink of default. This outage prevented a cascade of margin calls that would have bankrupted the clearing members, buying them time to manipulate the price back down in the thin holiday markets. For decades, allegations have swirled that bullion banks, led by JP Morgan, have managed the price of silver through massive naked short positions. In 2026, the bill has come due. The short position death spiral. The data from the CFTC's Bank Participation Report, DEC 2025, revealed that 22 banks held a net short position of 212 million ounces. At $30 silver, this was a manageable risk. At $80 silver, this represents a $10.6 billion liability. If the price resets to the true physical price of $130, the liability explodes to over $21 billion. This is not just a trading loss, it is a solvency event for the banks involved. The leaked memo intel report circulating in the John AG network site Leaked Memos, indicating that banks like Morgan Stanley are panic selling their silver positions to exit the market entirely. While these reports are officially unconfirmed, the market action supports the hypothesis: sharp, violent sell-offs followed by immediate buying. This is the signature of a forced liquidation, a bank trying to cover its shorts without spiking the price and failing. Force majeure, the nuclear option. The ultimate fear is that the Comex will declare force majeure, stating that due to unforeseen circumstances, i.e., they ran out of silver, they will settle contracts in cash rather than metal. Rumors suggest that the Comex may soon switch to cash settlement only. If the exchange settles your contract at $72 cash while the real price is $130, you effectively take a 45% haircut. This default would mark the end of the Comex as a viable price discovery mechanism and shift all global pricing power to the Shanghai Gold Exchange, where delivery is mandatory. The Bitcoin contagion. The stress is leaking into other assets. Bitcoin dropped from 126K to 88K in early 2026. This was not a crypto crash, it was a liquidity drain. Banks and hedge funds, bleeding cash on their silver shorts, were forced to sell their liquid winners, Bitcoin, to pay their margin calls on silver. The silver squeeze is effectively draining liquidity from the entire crypto ecosystem, proving that the crisis is systemic. While the West plays games with paper derivatives, the Brics alliance, Brazil, Russia, India, China, South Africa, plus Iran and the UAE, has launched the financial equivalent of a nuclear weapon, the unit. The golden anchor. The unit is a blockchain-based trade settlement currency backed by a reserve basket composed of 40% physical gold and 60% sovereign currencies. This structure is revolutionary because it creates a permanent bid for gold. As Brics trade volume grows, the supply of units must increase to facilitate that trade. To issue more units, the Brics central banks must buy more gold. This transforms gold from a passive reserve asset into an active trade necessity. It explains the relentless central bank buying of 2024-2025, where central banks accumulated over 1,000 tons per year. They knew the unit was coming. They were front-running the new system. Every barrel of oil sold by Russia to China, every ton of soy sold by Brazil, now creates demand for gold. De-dollarization as a self-fulfilling prophecy. The weaponization of the dollar, sanctions, swift exclusions, has accelerated this trend. The John A.G. perspective notes that this is not a political statement by Brics nations, but a survival mechanism. If the U.S. can freeze your reserves are not safe. Gold cannot be frozen, silver cannot be digitally deleted. Central bank gold reserves have now surpassed U.S. Treasury reserves for the first time in decades. This is the crossing of the Rubicon. Nations are voting with their balance sheets, choosing the barbarous relic over the full faith and credit of the United States. As we stand at this precipice, our analysis models 3 distinct timelines for the remainder of 2026. Scenario A, the neutral stagnation. Gold holds at $4,400 and silver stabilizes at $80. The arbitrage gap persists, but becomes the new normal. The West accepts a permanent premium for physical metal, and the Comex becomes a zombie market for paper speculation only. Scenario B, the supercycle, reset gold, pushes to 5,000 plus, and the gold-to-silver ratio compresses to 40.1. Historical norm is closer to 15.1. This catapults silver to $111–125 per ounce. The paper market breaks, and pricing power moves fully to Shanghai. This is the optimistic scenario favored by the breakdown of the technical data. Scenario C, the silver singularity, collapse. A deflationary crash drags gold back to $3,800 and silver to $50 on paper. However, given the physical shortages, this crash would likely only exist on screens. Physical premiums would skyrocket to 100% or more, effectively creating a black market for silver. The Comex declares force majeure, and the price of silver becomes unobtainium. No price is high enough to source physical metal because no one is selling. The John A.G. verdict. The video "Silver Back at 80" is not a news update. It is an obituary for the old world. The convergence of the Shanghai squeeze, the Brics unit, and the industrial inelasticity of silver has created a perfect storm. The window for acquiring physical metal at Western prices is closing rapidly. When the Comex declares force majeure, the price will become irrelevant, and availability will be the only metric that matters. We are witnessing the greatest wealth transfer in human history. It is not moving from the poor to the rich. It is moving from the paper to the physical.